Let's break down today on US indices. Right now on the 1 hour chart, we have this large reaccumulation from all-time highs. And we have a few reloads, a few reaccumulations that turns into a reload right here. So this is our reload reaccum. If you don't understand anything that I'm talking about, go to a resources tab if you already joined. If you haven't already joined, join our group chat where we trade Wyckoff and we teach you all these things. I teach you all these things and all these concepts. And obviously, if you have any questions, text me about it. So here, reload reaccumulation, we can possibly come down to mitigate it before coming back up. We're still in risk on bullish environment, but there's been an update. Labor market has been showing signs of instability. We know that Feds have been reserved with the rate cuts. Inflation data has been kept in control. There's been, little small, very small upticks, but generally we have it all under control, and the Feds are waiting to rate cut just to be safe. They don't want to repeat COVID, where we cut the rates too soon and inflation came crazy, spiraling out of control, like 9% or something like that. Right now we're at like 3% or something, and the goal is 2%. So the goal is pretty much always 2%. But the reason that the Feds haven't cut rates yet, not only is even though inflation data has been kept in control, is because the labor market. So the labor market has been strong, and so there was no real need to cut the rates. There's no signs of the rates not being cut hurting the economy. But once the labor market shows signs of instabilities and it shows cracks, that the strength of the labor market is cracking, then the Feds have a reason to rate cut. So if the Feds cut rates, which is very likely if the labor market is showing cracks in the strength, then what we're going to be seeing is even more risk on. But there's a nuance here. Once they cut rates, things are going to go out of control because inflation is going to go out of control. U.S. labor market was showing signs of weakness despite a low official unemployment rate. Okay, cool. So job growth, labor force participation, and hiring activity are pointing towards a slowdown. Signs of a weakness showing up. But if they cut rates too aggressively to try and fix this labor market weakness, we might see bullish risk on, but eventually, especially if they cut aggressively, it's going to show signs that we are in a recession or that the economy is already deteriorating and we're just trying to fix it. Because even though there's going to be cheap money going around, if we at any point see companies like Apple and whatnot, all the big companies, if their earnings are going down, if they're showing worse earnings, this is going to catalyze the economy to, or at least the U.S. indices, to spiral down in fears of recession and whatnot. The prediction here is that price is going to go up if they're going to cut rates because of the labor market. Price is going to then shoot down if large company earnings are showing signs of weakness as well, despite the rate cuts, which is then going to trigger a large sell-off, risk-off environment, which means that on the high time frame, we could then be looking for a large pullback into these areas. So there's this larger reaccumulation that took about a year. Will it come back to there? I'm not sure. But there's also the reload over here. So the reload right here to come back to, which is more likely. But at a certain point, demand will show itself down here, especially if at this point the economics turn and we turn into a risk on narrative. So what we're going to do from here is look for probably the reaccumulation up. Yeah, I think that's what we're going to do. I don't think it's going to come back down because I feel like, and this is just an idea, I don't actually know, it's just a guess, but I feel like if supply was too much, then it probably would have went down here. So the fact that we broke through using this reaccumulation, I think that's enough to keep going before it makes a reaccumulation that needs to pull back. I don't think this one is going to pull back. I think it's going to keep going up. But we'll see how that goes. For now, like I said, we are going to flip that out. Now we zoom into the lower time frame. There's an hour. Zooming into the lower time frame, we see Asia low. That has not been swept yet. We see previous day low. Then we see previous day high. I'm gonna go to 15 minutes, see how that looks like. Doesn't look too bad. I'm gonna go ahead and put Asia low right here and Asia high right here. So now we have our levels pointed out. Go to 5 minutes. I see a fair value gap right here, honestly. Let's see when that gets inversed. Hopefully it gets inversed today. I'll put this as 5 minutes. Now I'm comfortable with zooming in to 1 minute. I see the gap up. I think it's going to sweep. This is my prediction anyways. It's going to sweep in London session right now. It's about 4:30 for me. So London session, London and Frankfurt just started. So I think it's going to sweep here. Maybe want to go up. But yeah, I could see it going up. So I could see it coming up past this high. And this high is supposed to be up here, I believe. Yeah. So I think it has room to come up, and I think it will come up and break through this. There's a chance that it will come through, consolidate, maybe pull back a little bit, maybe bounce off the Asia high, then go up. But right now, I'm pretty bullish. I think it's a pretty bullish day. Now, that's the most probable. There is a chance that it'll come up, maybe consolidate, and then start dropping from here for some reason. But like I said, my bias, at least for now, unless some news happens today or something, it's pretty bullish. Tony with success is imminent. Coaching and trading. Here to break down a trade with the intraday strategy that I've created, combining ICT, Wyckoff, supply and demand, and economics together. So here's a breakdown. We had this morning, news came in, CPI data, inflation data came up, labor market, unemployment data came up. So all bad things caused a large high volume down candle. I was beginning to believe that we were going to have a bearish day and likely to tap into previous Asia's low, or current Asia, Asia session's low, before bouncing off. That was my bias before, after the news came out. Before the news came out, I was bullish. I had expected it to come up during London session, maybe bounce off of Asia high, go for New York highs. But that never happened. So news came out, inflation came up higher, unemployment came up higher. So what does that mean for us economically? As we know, Feds want to cut rates. Inflation came up, then they're not going to want to cut rates. But the nuance here is that unemployment data came up. So if unemployment is rising, they want to cut the rates because cutting the rates will help stabilize the economy, making borrowing easier, just pretty much picking things up with the economy, letting companies breathe, have more cash in order to have more employees. So if unemployment rates are rising, and the news that we got the other day about the labor market being weakened, showing signs of weakness, then we have both two things that want to go in opposite directions. Feds want to raise rates in order to keep inflation down, or Feds want to cut rates to help stimulate the labor market and keep the economy strong. Well, if we have both at the same time, that means the Feds have their hands tied. It makes it unclear of the direction of what we are trying to do, whether we are risk on or risk off. Risk on being people putting their money into things like US indices, for example, which is what we're trading, or real estate, sometimes gold, but gold can also be a safe haven. So risk off, meaning people will take their money out of these risky things, like crypto as well, and take it out of these risky things and put it back into the dollar and in safe havens like gold and silver. If you're wondering why I said gold is in both, I'll explain that in another video or something. But for right now, I just want to break down what the thought process was. We were looking to come back up. I expected it to maybe bounce off of Asia lows or yesterday's New York session low. But as we watched it come up at New York Open, I noticed a 3-minute bearish fair value gap formed by the news. So if I go to 3 minutes, I'll see it. I guess I'll do it for you. I'll just do it for you right now. But 3 minutes, you see bearish gap right here. So not only did we have these two big levels of rejection waiting nearby, but we also had this large 3-minute fair value gap. Well, it ends up that we see signs of strength coming out of a accumulation and a reaccumulation. And we break through with a lot of strength, and we end up sweeping past these liquidity draws. This is where I believe people would probably enter the market, or something of the sort, which adds on to liquidity, right? So this is a liquidity draw. It passed through and started to consolidate up here after New York Open. And so my thought process begins to get a little different. I thought maybe what we're trying to do is reject off of these bearish gaps right here. This 3-minute bearish gap that I was just talking about. So maybe what we'll do is reject off of Asian lows. Yeah, Asian lows. And send our way up to the high of this, or somewhere in the middle where we will meet supply if demand starts to diminish. So I was keeping my eye out. I knew today was a little bit of a riskier day. And so I'm kind of sitting on my hands a little bit, trying to understand where to go. Some people probably, maybe bought right here and took the trade up, but that's just a little too risky for me, especially since we're sitting in a bearish gap. So I see that it comes up above the bearish gap and comes down. So it was looking to inverse this gap, but it didn't. On the 3-minute chart, it ends up being a very large rejection candle. Okay, well, once that happened, I noticed that we formed a 3-minute gap, bullish gap right here, and a 15-minute bullish gap right here as well. So there was a lot of strength, there was a lot of support going on at this point. Not only do we have Asian low as a support, but we also have the 15-minute bullish gap and the 3-minute bullish gap. So right now I'm open to both sides. I'm open to both either all-time highs, or maybe we'll be coming down lower just because of the news. Well, what we end up doing is we come down to this 3-minute gap and reject pretty hard. After that rejection, I was, as always, switching between my time frames, checking to see what's different. I was focusing mostly on 1 minute and 3 minute because that's where most of the things were happening at that point. But large rejection, and then we end up consolidating just a little bit, and it comes down. I'm seeing a lot of signs of demand because, as you can see, it's coming back and forth. And if supply was very strong at this point, then it probably would have had some strength, right? So obviously, we're going to meet some resistance at this Asia low and this 3-minute gap and this 15-minute gap. So already I'm thinking probably going to take a long. Price comes down. It doesn't meet the gap yet, but ends up showing very large signs of demand. Demand comes up, hits this bearish gap right here, rejecting off of it. But it also creates a 1-minute gap right here. So this 1-minute gap forms, and I see the first rejection, one rejection. I see two rejections, and then I see a third rejection. Now, here's the thing. Yes, we had this bearish gap right here, this 1-minute bearish gap, but think about all the signs of demand that we just saw. We saw demand pose itself right here during this consolidation. It didn't even have enough supply to come down and test this gap anymore, or this or the line below. So obviously we were bullish and there was a lot of demand. And not only that, but we reacted to this 1 minute gap. So if we try to inverse this gap 3 times and we have not been able to, I'm going to place my bets. Now there's a chance I'm wrong, but I'm going to place my bets that we are going to go at least to Asia highs, because Asia highs is right here. So what I do is I place a long order right here when I see the signs of strength. I didn't wait for the direction candle to close. I just saw the sign of strength and I decided to close. I put my stop loss below this low. This is my invalidation point personally. So I put it down there, and that resulted in a 1 to 2.5 risk reward ratio. Price comes up and meets this high up here. I took a partial somewhere around here. Put my stop loss. Where did I put my stop loss? So I put my stop loss at that low, I believe. Yeah, like right below this low. So I moved my stop loss, half my risk, to make it a 1 to 4 at that point, and we end up hitting full TP. So full TP happens. Just a beautiful trade. Lots of patience exercised. I really wanted to show that to you guys as a live trade. And pair it with my video where I explain this strategy so that you can understand the thought process. At least for people who are trying to learn for free and don't want to join my community or pay for me. If you are interested in learning a little bit more, or you have some questions, or are having struggles, you can join my community using some link I probably put below or somewhere. And I personally teach people. I've taught over 40 people how to day trade profitably, $100,000 to $200,000 a year, consistently as well. And I've been profitable in trading for 4+ years. So by now I was looking for another long. This had not yet been the end of my trading session. I trade from 9 to 10:30, or I try to. So it was still pretty early, and I knew we just broke these the Asian high. So I was thinking maybe we can aim for New York session high, but I don't think I got the entry anytime here. So I just closed the computer and just left. We did get like this large rejection, but the thing is, I was looking at ES as well, and so ES, and by the way, ES also had this 3-minute bearish gap, which is let's see, 931. So 931 was about right here. So 931, the top of Asia session, was also around the area where this bearish gap was. The end of this bearish gap was. And throughout this whole time that I was trading and looking at this chart, keep in mind that I'm checking ES and looking at the correlation to see if there's any rejection level above. So during this trade, this whole time that I was watching and looking, I was also going to ES and looking at it and seeing, well, what's it doing here? If it's bouncing off of Asia low, that's a good sign as well, right? So that I did see that. And so I knew that the top of this bearish gap was right here at the same time that NQ was coming up to the Asia high. So it passes through, and we see the rejection off this 1-minute gap, but I also noticed right here that we barely had any space on Asia high on ES, which served as a really strong rejection point for us. So I did not want to take this trade to the longs, even though our plan, our strategy would allow us to. I knew that ES had a rejection point coming up that was super strong, and I didn't want to risk it. I'd rather just wait for ES to push through, create a fair value gap, and get an entry off of that instead. Two New York highs up here. So that saved me. That's why I checked the correlating tickers throughout the 100+ trades that I've back tested the strategy. Checking between the correlating tickers is always a good idea, especially ES and NQ together, because there are plenty of times where you have those rejection levels come up that make it so that you have no room to get a 1 to 2 minimum risk reward ratio. Like if I had taken this, I don't know, I might have gotten a 1 to 2 somewhere around here, but it was just too risky to chance it. So I'd rather, it's just not worth the risk for me. But yeah, that would have been a 1 to 2, but still, you get what I'm saying. It's possible that ES wouldn't have even touched Asia high, and instead we would have bounced off of Asia high on NQ, like this and inversed and came down instead of, you know, trying to touch Asia high for that. So again, adds on to the fact that it's just not worth it for us to take that risk on that trade.